Welcome back to Talk Tickers. This is the special edition of the Deep Dive, where we don't just read the headlines. We strip down the earnings calls that are actually moving the markets to see what is ticking under the hood.
And today is Wednesday, January 21st, 2026. A very interesting Wednesday at that.
Oh, yeah. If you've been watching the tape today, you know exactly why we are pulling up the file on Simmons First National Corporation, ticker symbol SFNC.
It's hard to ignore, isn't it? I mean, a pretty boring regional bank stock that closes up almost 7% on a random Wednesday in January.
Plus 6.85% to be precise, closing at $20.60. And the volume was there too, over 1 million shares traded. The market is absolutely buying whatever Simmons is selling right now.
Well, we have to remember the context. For the last year, the market's been, terrified of regional banks.
Right. They're usually sleepy. They're the safe, dividend-paying part of the portfolio. They aren't supposed to move like a tech stock. So when you see a move like that, you have to ask, what on earth did they say on that call?
It's a classic quality of earnings story. Investors were looking for proof that these guys can actually make money in this uncertain for longer rate environment without taking massive risks.
The tape doesn't lie, as they say. But before we get into the strategy, because I know you are dying to talk about margin expansion and basis points, Let's hit everyone with the headline numbers. What exactly did they print?
It was a beat across the board. The headline that flagged on the terminals was GAAP EPS earnings per share coming in at 54 cents.
54 cents. Okay, and what was the street expecting?
FactSet consensus was sitting at 48 cents. So that is a 12.5% beat on the bottom line.
Wow. In the banking world, a double-digit beat on earnings is significant.
It really is.
But earnings can be, manipulated with tax rates or buybacks. What about the top line, revenue?
That's the real surprise. Revenue came in at $249 million. The consensus was only $238.
Wait, that's up nearly 20% year over year.
It is.
20% revenue growth for a regional bank. Okay, now I see why the stock popped. That's not Arkansas banking numbers, that's tech company growth.
It's impressive. But if you stop at the revenue number, you miss the real story. The number that really matters here, the engine of the bank, is the net interest margin, or IN.
The NM. Okay, what was it?
It came in at 3.88%.
3.88%. Put that in context for me. Is that good, great, or?
It's exceptional given the yield curve we're dealing with. It's up 14 basis points from just the previous quarter.
14 basis points quarter over quarter is a huge move.
And if you look at their pre-provision net revenue PPNR, which is basically how much cash the business generates.
The raw horsepower of the bank.
Right. That hit $102 million. That is up 60% compared to a year ago.
60%.
60. And they did it with an efficiency ratio of just 56.7%. In banking terms, they're running very, very lean.
Okay, I want to unpack this because a 3.88% IM in this environment feels a bit like magic. Every other bank CEO I listen to is complaining about deposit costs eating them alive. How is Simmons pulling this off?
This is where it gets fascinating. On the call, they broke it down. It wasn't just luck. They saw a gross move of about 31 basis points in the margin.
31. Okay, break that down. Where did that come from?
About 19 basis points of that came from what they called a balance sheet restructure. They executed back in Q3.
Restructure is usually a scary word. It means, we messed up and we're fixing it.
In this case, it was good financial engineering. They basically reduced their reliance on expensive wholesale funding. Think of it as paying off a high-interest credit card. They paid off that expensive debt, and that immediately lifted the margin.
So they cleaned up the liabilities side. That explains 19 basis points. What about the rest, the other 11?
That came from core expansion.
Yeah.
And this is crucial. Simmons has flipped their interest rate sensitivity.
Explain that for the listener who isn't a bond trader. What does it mean to flip sensitivity?
Okay, so banks are either liability sensitive or asset sensitive. If you're liability sensitive, high rates hurt you. Simmons used to be that way. Now they're asset sensitive.
So if rates stay high or higher for longer, they win?
They win. Their assets, the loans, reprice higher and faster than their deposits do. And they have this massive tailwind built into their loan book that almost guarantees this continues.
How's a tailwind?
They mentioned they have $2.5 billion in loans that are repricing over the next 2 years.
$2.5 billion?
Yes. And the kicker is the current rate on those loans. It's less than 4%.
Oh, wow. I see where you're going. Those are I like to call them zombie loans.
Zombie loans.
Yeah, they're these old low-rate loans from the zero interest rate era that are just shuffling along, not making any money, but they're about to wake up.
That's actually a great analogy. These zombie loans are about to wake up and reset at current market rates. A loan written at 3.5%, when it matures, it doesn't renew there. It renews at 7%, maybe 8.
That is a massive spread. That is essentially doubling the revenue from that specific loan without having to find a new customer.
Precisely. It creates a natural floor for their margin. They said they expect the NIM to be stable to expanding, targeting the mid-3.80s range for the full year.
That is a great setup. But what about the other side of the coin? Deposits. This is usually where the story falls apart for these banks.
This was another bright spot, which surprised me. Their cumulative deposit beta, so how much they've had to raise deposit rates, is sitting at 64%.
64% seems okay. Not great, not terrible.
It's respectable. But here is the key. They have shed about $1.4 billion in broker deposits.
Broker deposits, that's the hot money, right?
Exactly. It has no loyalty. You pay top dollar or it leaves. Yeah. By getting rid of that $1.4 billion, Simmons has improved their mix significantly.
So they're getting stickier, cheaper funding.
Yes. And they actually expect their incremental beta on future rate cuts to be around 50%. So if rates fall, their deposit costs should fall even faster than they've risen.
So they've optimized the balance sheet to win if rates stay high because of the zombie loans, but they've also protected themselves if rates start to cut.
It's a very disciplined approach.
Yeah.
But margin is only half the story. The other half is just ruthless efficiency.
Yes. I noted a quote from the call that I absolutely loved. One of the execs dropped this line, "If it ain't broke, break it."
It's a striking philosophy for a bank, isn't it? Usually banks are the most conservative institutions on earth.
If it ain't broke, break it. That sounds like a Silicon Valley mantra, not a Little Rock banking boardroom. What did they mean by that practically?
They mean they're not satisfied with good enough. They're actively dismantling processes to rebuild them cheaper and faster, and the results are in the numbers. They reduced their total square footage by 6% this year.
6%? Is that just closing branches?
It's a mix. About a 60-40 split between retail branches and corporate office space.
That's a lot of rent and utilities saved.
It is. But the most impressive stat for me was this. Their total expenses in 2025 were below their run rate from the fourth quarter of 2022.
Wait, hold on. Since 2022, we've had massive cumulative inflation, and you're saying they are spending less now than they were 3 years ago?
That is correct. They have absorbed 3 years of inflation and negated it completely. That is why the PPNR is up 60%. Every extra dollar of revenue is falling straight to the bottom line.
That is incredible discipline. Okay, so we have expanding margins, we have the zombie loans waking up, and shrinking costs. But the market research flagged mixed asset quality. What went wrong?
It wasn't all sunshine. You're right to be skeptical. While the operational metrics were great, the credit side was a bit noisy. They had elevated charge-offs in the quarter.
Charge-offs are never good. What happened?
They effectively cleaned house. They sold off their equipment finance business and resolved 2 large problem credits that had been hanging over them.
So they ripped the Band-Aid off.
That's the charitable interpretation, and clearly the one the market adopted today. Management called it a deep dive. They're telling the market, the cleanup is done, the portfolio is stable now.
Do we believe them? Or is this the kitchen sink quarter?
It certainly feels like a kitchen sink quarter. And judging by the stock price, investors believe them. They seem willing to forgive the one-time charge-offs for a cleaner balance sheet going forward.
Right. If you think the earnings power is real, you ignore the one-time write-down. Let's talk about growth. Loan growth in Q4 was the highest it's been in years. Are they stepping on the gas?
You might think so. But management was actually very cautious about 2026. They called Q4 a pinnacle of pipeline timing.
Meaning a bunch of deals just happened to close at the same time.
Exactly. It was a coincidence, not a new baseline. Their guidance for 2026 is for low to mid single-digit loan growth.
Why so low? Is there no demand?
It's not demand, it's deposits. The CEO, Jay Brogdon, was very candid. He admitted their non-interest-bearing deposits are below peer levels.
So they are deposit constrained. You can't lend money you don't have.
Exactly. And there's a competitive dynamic here, too. Brogdon mentioned that competitors are pricing loans irrationally.
Irrationally.
Meaning other banks are offering loans at rates that don't make sense just to win the business. Simmons is stepping back from those low-return deals.
So they are choosing margin over volume. We will let the other guy take the bad loan.
Precisely. Which connects back to the theme of the day. earnings quality.
Which brings us to the investor context. Why should the listener care about a regional bank in Arkansas?
This is a classic regional bank re-rating story. For the last year, regionals have been in the penalty box. SFNC was actually down about 14% over the last year before today.
And the regional banking ETF, the KRE, was up about 9%. So they were a huge laggard.
A huge laggard. But this quarter signals a pivot. By proving they can expand margins and control costs, they are making a case to be re-rated higher.
So what are the catalysts to watch to see if this rally has legs?
3 things. 1, NIM durability. Can they hold that 3.88% level? 2, credit normalization. Was the Q4 cleanup truly the end? And 3, the deposit mix. Can they actually grow those cheap deposits?
It's a show me story.
Exactly.
All right, that brings us to my favorite part of the show, the "This is not financial advice" segment.
Disclaimer time.
You know the drill. We are not financial advisors. This is for entertainment. Do not trade based on what we say. But if we were pitching a wild idea to the investment committee, what would it be?
I'm curious where you're going with this one.
I call this trade the zombie loan repricing spread.
I love the name. Break it down.
The setup. We go long Simmons First National, SFNC. The thesis is purely mathematical. You are betting on that $2.5 billion bucket of sub 4% loans. It is a guaranteed revenue tailwind.
That's the long side. What's the hedge?
You short a generic regional bank ETF, like the KRE, or you find a competitor that is heavy on commercial real estate whose loans have already repriced higher.
So you are long the bank with the repricing upside and short the banks that have already peaked.
Exactly. And you layer on the efficiency angle. I'd call it the inflation-proof efficiency play. You are buying the management team that says, if it ain't broke, break it, and selling the bloated banks waiting for the Fed to save them.
It's aggressive, I'll give you that. But the math on that backbook repricing is compelling. You're arbitraging the time delay on those old loans resetting.
It's the zombie loan arbitrage.
Well, looking at the tape today, I think the market just woke up. That 7% move suggests the secret might be out.
Fair point. But there are still 2 years of repricing left.
That is true. Let's recap.
Simmons First National Corporation, Q4 2025. They beat on EPS at 54 cents. They beat on revenue.
The net interest margin expanded to 3.88%. Driven by a smart balance sheet restructure.
The stock reacted violently to the upside, closing up nearly 7%.
And guidance for 2026 is disciplined. Low growth, high efficiency, and a focus on profitability.
Management successfully navigated a restructure and came out leaner. The big question for 2026 remains. Is the credit cleanup truly done, or was Q4 just the tip of the iceberg?
That is the question that will determine if this stock goes to $25 or back to $17.
Thank you for tuning in to this special edition of Talk Tickers on the Deep Dive. Check the show notes for the transcript if you missed any of the numbers.
And as always, keep learning and keep questioning the narrative.
We'll see you on the next Deep Dive. This is not financial advice. Goodbye.